All right, welcome back to the deep dive. Today, we're diving into the closing market report from Market Deep Dive for October 31st, 2024. And seems like even the market got a little spooked this Halloween.
Yeah, it was definitely a trick rather than a treat for some investors, particularly in the tech sector.
Yeah, the report paints a pretty interesting picture, starting with the SPX. Saw its first monthly loss since April, dropping almost 1%.
Right.
Now, before everyone starts heading for the hills, remember, context,
Yeah.
everything.
Couldn't agree more. We're still up about 20% year to date for the SPX. This dip could just be a short-term correction within a larger upward trend, however. We did see the VIX, sometimes called Wall Street's fear gauge, hit a 3-week high.
So maybe just a bump in the road, but
Yeah.
potentially a little bit of a wilder ride ahead. What does this tech sell-off actually mean for those of us following the markets?
Well, it seems like some of the big players, like Microsoft and Meta platforms, might be the ghosts kind of rattling the cages this time around.
Okay, spill the tea. What's going on with these tech giants?
Their future spending plans seem to be causing some anxiety among investors. Microsoft is predicting slower growth for its Azure cloud platform, and they're going to be investing heavily in AI infrastructure.
So spending a lot, but potentially growing a little slower.
Yeah, I can see why that might cause some concern. And what about Meta? They've been pouring money into the metaverse, right?
Yes, and they're projecting even more capital expenditures next year, which is definitely adding fuel to the fire. And this is also putting pressure on semiconductor stocks.
It's crazy how even positive earnings from giants like Amazon and Apple can't seem to soothe the market jitters completely.
Yeah, you've hit on a key point there. It's not always enough to just exceed expectations. Investors are looking for strong signals for future growth and stability. When things get murky, even good news can get lost in the noise. It's not just about the numbers, it's about the story those numbers tell. But, hey, before we get too caught up in the tech drama, let's zoom out. Look at the bigger picture here. What's the report saying about the overall economic data? Any signs of a monster recession lurking in the shadows?
Well, the September personal consumption expenditures, PCE report, actually offered some good news, showed a 0.2% increase in headline PCE and a 0.3% increase in the core PCE, which excludes things like food and energy prices.
Okay, so we're keeping an eye on how much everyone's spending, and thankfully prices aren't surging like they were before. Does that mean that inflation is finally starting to settle down?
It does seem to be moderating, which is a positive sign. The report also mentions a slight increase in the 10-year Treasury note yield.
And I know a lot of our listeners are homeowners or thinking about buying a home. So what does that increase in the 10-year Treasury yield mean for them?
That's a great question. So this yield can actually influence mortgage rates and borrowing costs in general. So it's definitely something to keep an eye on, as it could impact your personal finances.
All right, so we've got a market that's a little on edge, but the economic indicators seem to be pointing in a more positive direction. Now, I always find it interesting to hear what the experts make of all this. What are the analysts saying about this whole situation?
The general consensus seems to be that we're headed for a soft landing, meaning the economy remains strong, inflation is easing, and we might just be able to dodge a recession.
That's good news. Are they seeing anything else that supports this idea of a soft landing?
They're pointing to the Employment Cost Index, or ECI, which measures how much companies are spending on wages. And it saw its lowest increase since the second quarter of 2021.
Hold on, so wages aren't growing as fast as they were before. Why is that a good thing?
Well, it suggests that wage pressures are easing, which could give the Federal Reserve, the folks who set interest rates, a little bit more breathing room. And speaking of the Fed, futures trading is suggesting there's a pretty good chance they'll cut rates in the coming week.
So it seems like a lot of things are pointing towards a less dramatic landing for the economy, but I know our listeners are also keeping a close eye on how individual stocks are doing. What are some of the notable movers and shakers from the report?
Definitely a lot to unpack there. First off, Amazon. They knocked it out of the park with earnings and revenue, sent their stock soaring after the closing bell.
No surprise there. Amazon's got their fingers in so many pies these days. Now, everyone's probably curious about Apple. Did they deliver the goods?
They did. They also beat analysts' expectations for both revenue and earnings. But here's the twist. Their services revenue, which includes things like Apple Music and iCloud, fell a bit short.
Interesting. So a mixed bag for Apple, but still a solid performance overall. What other big names caught your eye?
Well, Etsy stock had a nice rally, thanks to a strong earnings report. And they also announced a $1 billion share repurchase program. Seems like they're betting on themselves.
Yeah.
But on the other hand, the PHLX Semiconductor Index, or SOX as it's known, took a bit of a dip.
So good news for Etsy investors. Maybe not so much for those holding on to semiconductor stocks. What's driving that decline?
It's actually a few things. Weaker semiconductor sales from Samsung Electronics played a role, along with those mega-cap earnings reports we were talking about earlier. Plus, there's this new analyst report suggesting that Apple might reduce its reliance on Broadcom chips.
Huh. So like a chain reaction. With those big tech spending decisions kind of rippling outward, any other surprises in the stock movements?
Yeah, well, Uber's stock price took a tumble, even though they exceeded profit and revenue forecasts.
Wait, they beat expectations and still dropped? What's going on there?
It seems like their gross bookings, which is basically a measure of the total value of rides and deliveries, narrowly missed estimates, and their guidance for the future might not have been as, well, rosy as some investors were hoping for.
So even beating expectations isn't a guarantee of a happy market. It's all about managing those expectations, huh? Were there any bright spots that stood out to you?
Definitely. Carvana, their stock price soared after exceeding earnings projections, but on the other hand, you have MasterCard, which actually declined, even though they surpassed earnings and revenue expectations.
It's amazing how even in a volatile market, some companies manage to outperform, while others struggle, even with what seem like great results. It really highlights the importance of doing your homework, understanding the individual companies and their stories.
Absolutely. It's not just about chasing headlines or following the crowd. Individual research and due diligence are key. Now, the report also highlights a couple of upcoming economic data releases that investors should keep on their radar.
Okay.
The non-farm payrolls report for October and the ISM manufacturing PMI.
Okay, those sound important. Can you break those down for us? Why do those reports matter? Especially for our listeners who are trying to make sense of where the market's going.
These reports give us some really valuable insights into the health of the U.S. economy. The non-farm payrolls report, especially, is closely watched because it tells us how many jobs were created. And job growth is a key indicator of economic strength.
So basically, more jobs, stronger economy.
Generally speaking, yes. But it's not always that simple. There are a lot of other factors at play. As we've seen in this report, interest rates, inflation, investor sentiment, all of those can impact the market. Now, the ISM manufacturing PMI, that gives us a snapshot of the manufacturing sector, which is another big driver of economic growth.
So if both of those reports look positive, it could be a good sign for the market overall.
That's a pretty reasonable assumption. But remember, investing is about managing risk and making informed decisions based on a whole range of factors. These reports are just two pieces of a much larger puzzle.
It sounds like staying informed, understanding the economic landscape, it's all crucial for navigating the market effectively.
Exactly. This report really underscores the importance of going beyond the headlines, really digging into the data to make informed decisions, especially for those individual investors out there.
Speaking of digging deeper, this report also gets into some technical analysis, specifically looking at moving averages and support levels. I know those terms can sound a little intimidating to some folks. Can you break down what those mean and why they matter?
Of course. So technical analysis at its heart is really the study of past market data, primarily price and volume, to try and predict future price movements. So it's kind of like looking for patterns and clues in the market's behavior.
So like being a market detective.
Exactly.
What about those moving averages? What are those all about?
A moving average is basically a line on a chart that smooths out price fluctuations over a certain period. The report mentions the 20-day moving average, which is just the average price over the last 20 days. Traders use these moving averages as indicators of potential support or resistance levels.
Okay, so it's like a trend line. Helps visualize the market's overall direction.
Precisely. And when the price drops below a key moving average, like what happened with the SPX recently, it can signal a potential shift in momentum. That's why this report mentions a near-term bearish tilt, suggesting the market might be headed down in the short term.
So while the long-term outlook for the market might still be positive, these technical indicators suggest we should be a little cautious in the short term.
I think that's a reasonable takeaway, but it's important to remember that technical analysis is just one tool in the investor's toolkit. You always want to consider it alongside fundamental analysis, which looks at a company's financial health, its growth potential, and the overall economic environment.
This is all great information. I feel like we're starting to put together a much clearer picture of the market, how it's behaving, and what it means for investors. What are your final thoughts on this market report?
I think the main takeaway here is that even with all this uncertainty and volatility, there are still opportunities out there for those who are informed and do their research. The tech sector might be going through a bit of a meltdown, but the broader economy seems to be holding strong. And there are definitely some bright spots across different sectors and individual stocks.
And it sounds like staying informed, doing your research, and not letting fear kind of take over are key for navigating these choppy market waters.
Absolutely. Knowledge is power, especially when it comes to investing.
Well said. Now, before we wrap up, there's one more point in this report that I think is worth highlighting, especially for our listeners who are interested in understanding the global market. The report mentions that the Bank of Japan, they're also known as the BOJ, decided to keep its interest rates unchanged. Now, I know this might seem a little off topic for our listeners who are mainly focused on the U.S. market, but why is this decision, across the globe relevant to us?
That's a great question. It really highlights how interconnected global markets are. While the BOJ's decision might not have a direct impact on U.S. stocks, it does affect the global economic landscape. Japan is a major player in the world economy, so their monetary policy decisions can create ripple effects across different markets.
So even though we're really zeroing in on U.S. stocks today,
Yeah.
it's still important to keep an eye on what's happening internationally.
Absolutely. Global events and economic policies can definitely influence U.S. markets in some pretty unexpected ways. For example, a weaker Japanese yen could actually make Japanese exports more competitive, potentially impacting U.S. companies that compete in those same markets.
It's amazing how it all ties together. So as we wrap up our deep dive into this market report, what are some of the key takeaways? What should our listeners keep in mind as they navigate this pretty complex market landscape?
I think the most important message is this: stay informed. And don't let fear drive your decisions. The market is cyclical, goes up, goes down. Volatility is a natural part of that. By understanding the underlying trends and really doing your research, you can make informed decisions that align with your long-term investment goals.
Yeah, it's so easy to get caught up in those headlines and fear missing out. But having a clear strategy and sticking to it is essential.
Couldn't agree more. And remember, there's no one-size-fits-all approach when it comes to investing. What works for one person might not work for another. It's all about finding an investment style that, really aligns with your risk tolerance, your time horizon, and your financial goals.
Such great advice. I think that's the perfect note to end on. Thanks for joining us on this deep dive into the market. And as always, we encourage all of you listening to continue exploring, stay engaged with this ever-changing world of finance.
It's been a pleasure. Remember, everyone, knowledge is power. The more you understand, the better equipped you'll be to navigate the market and reach those financial goals.
Until next time, happy investing, everyone.